I had a friend who was a quantitative analyst in a famous trading company. He was in charge of algo trading there and he worked on different trading systems for the company. One time I asked him what kinds of formula or algorithms they use in their trading system, and he said we only focus on proven mathematical and statistical principles in our trading systems. He said we transform the price data into z-score, and so we can apply statistical models and measure the probability of the expected outcomes. In this video, I want to introduce an advanced indicator that is built based on this concept, and you can have it for free on TradingView platform. Just make sure you watch this video until the end and let's get started. But before we start, if you like my contents, please support the channel by liking the video and subscribing to my channel if you haven't subscribed yet. Alright, now let's add the indicator. Here we click on indicators and we search adaptive z-score oscillator. This one, which is a new indicator from Quant Algo. Alright, this is the indicator, and as you can see, it is added here below the chart. As I said, this indicator is built based on z-score. In case if you don't know what z-score is, z-score measures how many standard deviations a data point is from the average of a data set. I don't get into more details regarding the formula and calculations, but just know that when a data set is transformed into z-score, it follows a type of special distribution which is called standard normal distribution, and this helps to analyze the data set in terms of probabilities and also apply statistical methods to the data set. This is exactly what this indicator does. It transforms the price action into z-score by calculating how many standard deviations the current price is from its moving average, and then it shows them by the help of this histogram. Alright, now let me teach you how you can interpret this indicator and how you can use it in your trading decisions. But before that, I'm proud to announce that recently I published a book, The Art of Price Action Trading, which is a complete guide to price action analysis. The link is in the description and you can get it later if you want to master price action trading. Alright, getting back to the indicator, as you can see, we have a histogram here, and depending on the direction of the market and situation of the market, it can be above the center line or below the center line with different colors, as you can see. This histogram is based on z-score, so for every data point, it is either above the center line or below the center line. Here, the center line is considered the average. Before we continue, we go to the settings of the indicator, and here for the length, we set it at 34. So the indicator will be less responsive to short-term fluctuations in the market. Alright, so when the histogram is above the center line, the color is green, and it tells us that the price is trading above the average, so the price is advancing in an uptrend. And on the other hand, when the histogram is below the center line, it tells us that the price is trading below the average and the price is declining in a downtrend. So we can use this histogram for trend identification. When the histogram is above the center line, the market is trending up, and when the histogram is below the center line, the market is trending down. You can clearly see that the indicator is perfectly showing trends of the market, and so the first use case of this indicator is trend identification. So for example, if in your trend following strategy you need to identify trends, this indicator is a perfect choice for you. When the histogram is above the center line, we look for long position opportunities inside the uptrend, and when the histogram is below the center line, we look for short position opportunities inside the downtrend. But this is not all, and the indicator provides more information. You can see that the histogram also has another color, which is gray. The gray color happens when the market is flat, short-term flat, which usually happens in the pullbacks within a trend. It will not help you with trading ranges with larger swings of the price. This only shows you short-term flat market. For example, here you can see that while the histogram is below the center line and telling us that the market is trending down, you can see that in the pullbacks, the color of the histogram histogram becomes gray, or during this uptrend, you can see that whenever there is a pullback, here the histogram is gray. Also, when a reversal is happening. Actually, when the histogram becomes gray, it shows that the momentum is weakening. For example, here, since the histogram is above the center line, when it becomes gray, it shows weakness in the upside momentum. Or, for example, here, the gray color shows weakness in the downside momentum. This weakness can be temporary because of a pullback, or we can have a reversal after that. This feature of this histogram is very helpful for two types of trading strategies: trend following strategy and breakout trading strategy. In trend following strategy, after identifying the current trend, you want to enter in the pullbacks, and here the histogram helps you to know when there is a pullback and when end of the pullback. In a downtrend, when the histogram is below the center line, when the histogram becomes gray, it's a signal that probably a pullback is happening in the market. And when it becomes red again, it tells us that probably the pullback ended and the price is gonna decline more. Similarly, during an uptrend, when the histogram becomes gray, it is a signal for pullback, and when it becomes green again, it is a signal that probably the pullback ended and the price is gonna advance more. Alright, now let's talk about these two dynamic lines that we have here. One excellent feature of this indicator is that it dynamically changes the levels of the threshold based on the current condition of the market. In other oscillators, the overbought and oversold levels are fixed, but in this indicator, they are dynamic. They change based on the volatility of the market. When there is higher degree of volatility in the market, the thresholds expand to be responsive to the wider swings of the price. And when the volatility is low, they contract so they can capture the smaller swings of the price. One problem with fixed levels is that when the market shifts between volatile and ranging condition, they give many false signals. But with these dynamic levels that we have here, the number of the false signals are considerably reduced because they can adapt to the current condition of the market. During a downtrend, which is when the histogram is below the center line, when the bars of the histogram goes below the green line, this shows extreme levels, and this is a signal of oversold. So turning of the price is expected to happen. But please pay attention that this turning of the price is not necessarily a reversal, and after oversold condition, we can just have a pullback, which is the case for these oversold conditions that we have here. So when we have oversold condition in this indicator, it only tells us that the price is far below the average and the weakness of the downside momentum is expected to happen, which causes turning of the price. This turning of the price can be just short in the form of a pullback, or we can have a complete reversal in the trend of the market. Similarly, in an uptrend, when the bars of the histogram goes above the red line, this shows overbought, so turning of the price is expected to happen. This turning can be just a pullback, like for example here, or we can also have a reversal and turning of the price from uptrend to downtrend after the overbought condition. Please pay attention that sometimes when the bars go above the red line, or on the other hand below the green line, they can stay there for an extended period of time and the price just keep advancing or declining in the case of downtrend. And so this can also show strength in the market, but that strength would be finally exhausted and the bars will go down below the threshold, and so the price reversing and going for a pullback or reversal in the trend. In this indicator, if we mix overbought and oversold signals with the divergence concept, we can easily identify reversal points of the market. For example, here, following this uptrend, you can see that here we have overbought reading, and after that the price made same level, but the indicator didn't follow, and you can see that the indicator made a lower high. This is a bearish divergence and it shows that the downside momentum is gaining a strength and there is a possibility for reversal of the trend. One excellent confirmation is based on price action. Here we mark the low of the divergence pattern and we wait for a candle to be closed below this level. You can see that it happened here by the help of this candle. So the reversal is confirmed here and you can see how the price turned to a downtrend. On the other hand, following this downtrend, after this oversold condition that we have here, you can see that the price made lower low, but the indicator didn't follow and it made higher low. This is called bullish divergence and it shows that the upside momentum is gaining a strength and there is a possibility for reversal. For the confirmation, we mark the high of the divergence pattern and we wait for a candle to be closed above this level and you can see how the price turned to an uptrend after that. This indicator is one of the best and most accurate indicators that can effectively help you to analyze the charts and validate your trading decisions. You should never use only this indicator for your trading decisions and you must use it in conjunction with other indicators or aspects of technical analysis for taking a trading decision. And please pay attention that no matter how much accurate is your indicator or your trading strategy, you can never have a trading system with 100% guaranteed signals. Losing positions are always part of the game and you need to manage your risk properly. There is a risk management strategy that is called 1% rule and it is one of the best risk management strategies that you can use. I have a complete guide on this. The link is also placed in the description and I highly recommend you to watch it because without a proper risk management strategy, you cannot become a consistently profitable trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.